Hi, I'm Amanda Hahn.
And I'm Matt MacFarland with Keystone CPA.
And thank you for joining us as we go over the top 6 real estate tax mistakes that you need to avoid.
Mistake number 1 is believing that I need an LLC to write off expenses. You ever heard that before?
Yeah, this is a common one where people think or people are told that they have to have an LLC in order to write off real estate related expenses, and that's not true at all. In fact, all real estate investors are business owners in the eyes of the IRS. So if you are investing in real estate, whether it's owning your rentals in an LLC or in your individual name, or flipping properties individually or in an entity, you are able to write off the vast majority of common expenses to offset your rental income. So some of the things that you can write off, again, with or without an entity, include travel, business meals, business car uses, home office expense, educational expenses, whole gamut of things that could be deductible with or without an LLC.
All right, mistake number 2 is believing that home office is an IRS red flag item. And this is very far from the truth. I mean, this might have been true 20-something years ago when it first came out. But think about it, a lot of people, I think I read an article a couple of years back where over 50% of Americans were working from home or had some sort of home-based business, right? And, just a couple of years ago, the IRS actually made it easier for people to take the home office deduction by providing a standard deduction right off for the home office. So don't be afraid to take the home office deduction. If you have a space at home that is exclusively used for your business and you are, regularly using it for your business and running your business from your home office, make sure you're taking advantage of the home office deduction.
All right, mistake number 3 is believing that only realtors are real estate professionals. And that's not true at all. But first, let's talk about real estate professional briefly. The benefit of being a real estate professional is that the investor has the ability, or higher income investors are able to utilize rental tax losses to offset other income outside of just the rental income. So a pretty significant benefit for any investor who is also a high income earner, or maybe their spouse is a high income earner. And the way to get around that limitation is to be a real estate professional. So one of the common myths that we see is people believing they have to be licensed as a realtor to be a real estate professional. But when in fact, the real estate professional status in the tax world is only strictly looking at the number of hours and activities that someone is spending in real estate, and not necessarily looking at whether someone is holding a license in real estate.
Okay, mistake number 4 is believing that only real estate professionals can take tax deductions. As we mentioned, real estate professional is a way that gives you the ability to, if you have a loss from your rental properties, gives you the ability to deduct that loss against your other sources of income. But before you have a loss, you're going to have deductions, right? So every real estate investor is going to have rental income minus expenses minus depreciation. Every investor is going to have that, right? Regardless of whether you're a real estate professional or not. So just being a real estate professional doesn't change the fact that now I can deduct that thing that I couldn't deduct before, or what have you, right? That's a big mistake. Again, the real estate professional just allows you to, once you have that loss, where your expenses exceed your income, that gives you the ability to use that loss to offset your other income.
All right, mistake number 5, not claiming depreciation correctly, or maybe not claiming it at all.
Yeah, we see this all the time where we'll start working with a client and we're looking at their old tax returns and we notice that they've not depreciating their building correctly, or maybe they weren't taking advantage of, accelerated depreciation, or in some instances, not taking depreciation at all. I mean, we've seen returns where someone's owned a rental property for 10 years, never claimed depreciation expense, believe it or not.
Yeah, and something important to keep in mind is that depreciation is based on the purchase price of the building, not on the down payment, not on the fair market value. So if you bought a building for $300,000, the depreciation is typically the same regardless of whether you put 20% down, no money down, or even an all cash purchase.
Or whether it goes up in value over time. We get that question a lot too. It's like, I paid $300,000 for it, it's worth $700,000. How do I change my depreciation? Well, that's, again, it's based on your original purchase price, but make sure you're taking advantage of it because it's a huge write-off that's available to you.
All right, mistake number 6 is thinking that tax planning and tax return filing are one and the same, and that's actually incorrect. So tax return filing is when someone takes the numbers you provide them, your tax preparer, right, and then they report all those numbers on a tax form. This is done after the year is over, right? Sometime usually in the following February or March or April. That's really just reporting historically what happened in the past. What we like to joke and say, this is the tax filing is to tell you what your taxes died from, right? This is the money that's going away. Proactive planning, on the other hand, is when you're meeting with your tax advisor throughout the year and strategizing on what are all the things you can be doing to make sure that you're legitimately minimizing your taxes. And for some people, the tax filing and the planning are done by the same person, right? And so if you're one of those investors where when you meet with your person to do your taxes for last year, you are also spending the time with them to go over what could be done next year proactively, then that's great. You're ahead of most investors. But if you're only meeting with them to do the tax returns, make sure that you spend the time to meet with them to do the proactive planning. That could be in the same trip, it could be scheduling a future meeting. And then last but not least, if your current tax preparer is not someone who offers that service or provides that kind of service, you can always work with another tax advisor who specializes in the proactive planning side. Because again, planning helps to provide you with options for ways to save on taxes before you enter into a transaction, before you sell, before you buy, before you form a legal entity. And that's one of the best ways to help you significantly reduce your tax bill come next April.
Please make sure you like, comment, and subscribe to the rest of the BiggerPockets video series.
Yeah, and make sure to check out our book. It's called Tax Strategies for the Savvy Real Estate Investor, and you can find that on BiggerPockets. For more information, always feel free to visit our website at KeystoneCPA.com as well. Thanks for joining us.